This week promises to be a big one for investors. Yesterday, technology stocks surged higher, suggesting investors are undaunted by the big rally in tech shares last year. Tomorrow, new inflation numbers are due, and as always, they will help reshape investors' views of the macroeconomic backdrop and the outlook for interest rates in 2024. And the big U.S. banks begin reporting their fourth quarter results on Friday, kicking off earnings reporting season for S&P 500 companies. For his view on markets, let's go to our featured guest of the morning, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. Thanks a lot, first of all, for coming in. Good to see you.
Great to be here, Paul. Thank you.
What is your take on the macroeconomic and market environment as we launch 2024?
Well, Paul, we're coming off of a very, very strong 2023. That's particularly true in the United States and particularly true in the technology sector. But markets, as ever, are forward-looking, and as investors, so too are we. And so what our team at First Avenue Investment Counsel is seeing, looking ahead at 2024, is more and more a divergent path between the economic growth prospects here at home and those in our neighbor to the south. And so I think maybe starting with the commonalities, it's fair to say that both economies are decelerating and have been decelerating for quite some time, really 2 years after that tremendous reopening wave in 2021 post the draconian COVID lockdowns. But if we look at consensus economic growth forecasts for Canada and the United States for 2024, Paul, what we see is in both countries below trend growth prospects, but significant difference between Canada and the U.S., where the consensus of professional economists is forecasting Canada's economy to grow about 1.3% in 2024. The United States to grow 1.3% in 2024, whereas growth here in Canada is a very, very tepid, almost stall speed, 0.5%. And so for us as investors, it's causing us to train our eyes a little bit further, and we're finding more and more opportunities on the U.S. side of the border this year and late last year relative to here at home in Canada.
What will you be watching for from big U.S. companies as they roll out their fourth quarter earnings in the month ahead or so?
Well, actually, really starting just a few days from now, we'll start seeing the big U.S. money center banks late this week, and those are always good to keep an eye on because, you know, the likes of J.P. Morgan, Bank of America, Citi just have such a broad read on consumer spending and consumer and business confidence. So we'll be looking for their commentary on credit provisioning, expectations for the path of monetary policy, expectations for, loan demand. And also trends in spending on credit cards, that sort of thing. So their guidance, as always, and sort of the soft stuff in between the hard numbers is usually where the good juicy bits are when they report their results.
So you're spending more time on behalf of clients looking for opportunities in the U.S. One opportunity you've identified is shares of Uber Technologies. Why?
Yeah, so Uber Technologies really, Paul, fits thematically with a number of companies we've introduced to both our momentum and our dividend growers mandate at First Avenue in the last couple of months. And that is to say, we're looking for companies that are secular growers, companies that are disruptive game changers in some cases, but not in every case, in the technology segment of the market. And so Uber is so disruptive that, the name of the company has almost become a verb. It's become synonymous with ride sharing. And additionally, of course, as viewers will know, they've built out a very nice complementary business in food delivery, and beyond that, they've got a smaller truck freight business. And they're actually test piloting an odd job service somewhat akin to TaskRabbit in a couple of different markets. So, they built a great platform with strong network effects, and they're finding ways to bolt on adjacent services to it. And it's just creating a lot of value, and there's a lot of financial momentum built up such that they should have explosive earnings growth this year after years and years and years of investment in their core capabilities.
Right, I was going to ask, how profitable is Uber now? They've transitioned into profit. profit, have they?
Only very, very just recently, but
Right.
because of the tremendous operating leverage in a platform company, a platform technology company like Uber, once you turn the corner, earnings can double and triple, and then go on and double and triple again rather quickly in a period of just a few years. So, if you look at it superficially, it looks, somewhat expensive just looking at 2024 earnings. But as always, investors would do well to take the long view and look out a couple of years because the earnings are really poised to grow quite explosively over the next 2-3 years there.
McKesson is another investment you've made on behalf of clients in the U.S.
Yeah, so McKesson, of course, is not nearly as disruptive. It's a very old business. It's a pharmaceutical drug distributor. It's actually got a small business here in Canada as well, which is likely a household name for most. It's the Rexall retail pharmacy chain. But their big business, their core business in the United States is as an intermediary between branded and generic drug manufacturers and the endpoint buyers of those molecules, whether that be retail pharmacies or hospitals, long-term care homes, clinics, and what have you. And it's a very, very stable, non-cyclical market. It is a de facto oligopoly with the top three players having a combined 90% market share. Mm-hmm. And McKesson is the largest of the three, so does benefit from those scale effects, and also very, very, very sticky customer relationships. No retail pharmacy has changed drug distributor in at least the last 10 years. So it's the kind of company where you've got a good line of sight to double-digit or high single-digit dividend growth for the foreseeable future, driven by secular and demographic forces in the United States economy, notably the big growth in healthcare spend.